banks were bailed out illegally, not bailed in. We
Mm-hmm.
added 14,000 clients in 45 days, Danny, when those banks failed and they were bailed out illegally. So you see a bank bailed in or money market funds gated, um, the panic would be if you and I discuss this right now, and I said to you, Danny, it was bailed in, they've lost everything. When you got off this podcast, how fast would you have be on your computer or running down to your bank to pull your money out? And I don't care if you bought gold or art or cars or whatever the hell you did, would you want to leave your money in a banking system if a big bank was just bailed in? I mean,
We,
it
we
will
saw a
incite.
microcosm of that. We saw a microcosm of that with SDB. We started to see lines start to form outside of these banks. And I
But
mean,
they were
that
bailed
was not
out.
even a bank bailing.
Right. Wait till the bank bail in. And that's when the realization happens. And, people don't get it. It's law, but how many people even know what Dodd-Frank legislation is?
Right.
And I just think that it would incite. Now, when you talk about could it be planned? Well, what does a modern monetary theorist want? Modern monetary theorist wants to issue money directly from the Federal Reserve, and 5,000 banks get in the way. Jerome Powell told us there would be consolidation. See, I told you, here are the crumbs. I told you guys there'd be consolidations. But what does that really mean? How do you really consolidate the banks? Imagine a Bank of America was bailed in. What would happen? And everyone lost everything. How fast would everyone go to every bank across the country and yank their money out? That's the thought I want people to take away from this interview, if nothing else. What would that systemic chain reaction look like? Oh my God, bank, they just lost everything. Our neighbors lost everything. Get to the bank now. Like they would say, the wife would say to their husband, honey, get in the car and go. Get our money now, because it's going to happen here. And then bang, 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 bang. A chain reaction. Not only that, because of derivatives and credit default swaps, all of these insurance companies and banks are all tied together. That's why AIG was bailed out, because they issued the credit default swaps, which is if you and I are trading and I don't really trust you, I'm going to take an insurance policy out against you failing. And that's what AIG would do. And when the banks started to fail, AIG started to go boom, because they didn't have enough money to reinsure the insurance. So anyways, don't want to go too far down the rabbit hole, but I think it's really important that people pay attention to what we just said here and do some due diligence. Google Dodd-Frank Act /bail-ins, Dodd-Frank Act /money market gating.
In just 45 days, 14,000 clients rushed to protect their assets after illegal bailouts rattled the financial world. Imagine if, instead of bailouts, banks were suddenly bailed in, leaving ordinary people's savings on the line. Andy Schectman reveals the potential fallout of this hidden crisis, warning of systemic risks few understand, like the Dodd-Frank Act, which legally allows banks to seize deposits in a crisis. As global financial power shifts with countries like China and Russia buying record amounts of gold, it's clear this isn't business as usual. Are your savings secure, or could they be the next casualty in a rapidly changing financial landscape?
Gold making all-time highs. It's the 34th of the year, all-time highs. You got all the BRICS nations buying up gold, and that demand, it's not stopping. It's not going anywhere. They're buying it at a record pace, and I think that this is just beginning. It's broken through resistance levels. Of course, we're at all-time highs. It continues to march higher and higher and higher, and how high it goes, I don't know. I think bull markets go higher than anyone thinks possible. I think that it will be tied to a new system, but in reality, what I think it is more than anything is a realization that central banks around the world do not have the appetite for our treasuries any longer that they once did. Not only are we proving to choose inflation instead of letting the underbrush burn, letting Mother Nature clear everything, we're meddling again and lowering rates and reigniting inflation. That's why the bond market sold off and rates on the 10-year have been going higher, because they understand this. But of course, as we've talked about incessantly and ad nauseum, it's the weaponization as well, where we are, taking $5 billion in assets from Russia and buying weapons to give to the Ukraine. Our policies are making countries around the world want to own things like gold instead of owning our treasuries. Not only has it doubled the performance of the 10-year, has no counterparty risk. And you're right, you look at silver. And by the way, on COMEX, on the LBMA, London Bullion Metals Association, you're seeing roughly 2 times global market production traded every day in London. They have way less metal behind these trades. About 90% of these trades are paper trades, and if called on the carpet, it creates a very big problem. There's not even enough gold in the exchanges to come up with to deliver if need be, but more so in silver. Let me look at the numbers here. You mentioned that silver made a 12-year high. It's true. Closed up 6.5% on Friday. And what's going on with silver is ridiculous. You have 3.5 times global mine supply annually traded every day in London. There's 800 million ounces in the entire LBMA vaulting system, of which 500 million belong to the ETFs. That leaves 300 million ounces there that could be delivered. Well, they're trading 2.9 billion ounces a day, which is 3.5 times annual mine supply, 10 times what is available, 90% of which is paper. 8.1% of all of that silver was delivered in the month of August, as these countries are standing for delivery. And you got analysts like Bank of America saying that gold will be 3,000 by next year. You have 3,100 by Goldman Sachs. You got Michael Hartnett from Bank of America saying that gold bull driven by policy and inflation. Investors simply need to hedge inflation and threat of U.S. dollar debasement. Gold heading well above 3,000. Yeah, I don't think we've even begun to see where this ultimately goes, but silver is the value of a generation. And I think the entities around the world understand this. You have China, as I mentioned on your show before, going around the world buying concentrate and doré bars directly from the Latin American refiners. They are paying way more than the West will pay for it. They bring it home and refine it themselves. It's not purchased off of an exchange, which has a material effect on the price they're paying and on how much they're really accumulating. They already are the second largest producer of silver in the world. They have become a net importer this year instead of net exporter. India, of course, bought between 800 and 900 million ounces over the last 3 years. That's more than is on the LBMA. And now Russia openly saying they're going to add to it as part of their state stockpile. Now, no countries have said that ever, really, to my knowledge, and now Russia is. So you have countries realizing the weakness to the system, or the way to beat the West is not through military engagement, but it's to stand for delivery, which is kind of the back door that no one ever utilized on COMEX and the LBMA. And you have 8 commercial banks on COMEX, Western banks, that hold the largest concentrated short position in any commodity ever traded on COMEX. And you have between 4 and 6 billion ounces short in silver by pretty much the same group on the LBMA. So if silver went up by $2 on Friday, that's between what, $8 and $12 billion loss to these banks. Now, I can't give you a definitive number how many ounces, because it's an over-the-counter market in London. It's not an exchange where there is a central exchange authority that monitors everything. This is a over-the-counter handshake type of deal. It's more opaque. It's not as transparent, but we do know that roughly between 4 and 6 billion ounces short on London by these banks, and they're hemorrhaging. And how much longer can they take this acting in concert together in a collusive manner before they say, every man for himself, I'm out, bye, you deal with this, and they start to cover. And as covering happens, which is hard enough of it in and of itself, because these contracts are 90% paper, what happens to the price? It just goes up, which then snowballs the short covering price going much, much, much higher. And again, this is all because of creating this illusion that, holding the price of gold and silver down. And you can say it's because of the military industrial complex's need for silver. You can say they hold gold down to make the bond market and the Western system seem stronger than it is. Whatever the reason is, it is been discovered by China, Russia, India, Saudi Arabia. They're all exploiting the delivery feature option that no one ever did before, standing for delivery. And these entities, well, they got enough money to challenge the commercial banks and wherewithal to stand for delivery. They don't get scared by a margin call. If the price starts to fall, that's okay. Here's a little more margin. We're still standing for delivery. Thank you very much. And that's what is creating an existential threat for some of these banks. And all it takes is one to go down when the daisy chain starts to really get crazy, not just in precious metals. You're talking the biggest commercial banks in the world, Citi, JP, Goldman, UBS, Deutsche Bank, Standard Charter. These are banks that if they make a default in one area, what does it do to the rest of their book on all of the other types of assets that they trade in? So yeah, I think we're right there at that Rubicon. And in terms of silver, the closing above 3250 is incredibly bullish because that was one of the resistance levels. There might be one more at about 35. After that, there's nothing between it and 50.
Now you know the risk lurking in the financial system, so the next step is understanding how to protect yourself. Make sure to check out this next video for critical insights on safeguarding your assets in an uncertain world. Don't forget to like, comment, and subscribe to stay ahead on the latest financial news and strategies.